Hello. In today's video, we will be discussing a very crucial topic, which you can see in the screen that, how to build a diversified investment portfolio. And, building a diversified portfolio is the key to manage risk while maximizing return. And that is going to be your, long-term plan. And that's how your investment has to be made. So if you're serious about, growing your wealth, you need to make sure that your portfolio is actually diversified into different asset instruments, and that we will be talking about in this session. So today we are going to cover what is a diversified portfolio and why it is important and how you can create one which is tailored to your financial goals, especially in the Indian context. Okay, so let's get started with the video. So the topic is how to build a diversified investment portfolio. So let's start with, what is diversified portfolio? See, the first thing first, what exactly is a diversified portfolio, right? A diversified portfolio is actually a mix of different types of investments that help to reduce the risk while aiming for stable returns. So when you diversify, your investment, the thing is that the risk is also diversified. Okay, so it will reduce the risk and you will get some stable returns. And it's based on the idea that not all asset classes move in the same direction or react the same way to market conditions. So sometimes when the stock goes up, you can see gold will go down like that. There are, there is no such direct correlation with all of these, right? So some can go in one direction, some others can go in different direction. So that's the reason why we are looking for diversified portfolio. So think of it like this. If you put all your money in one stock or one type of investment, you are taking a significant risk. But if you spread your investment across various assets, right, we are talking about not only stocks, not only equities, you're talking about bonds, gold, real estate. You are minimizing the impact of any single asset performing poorly. So we have already discussed about the combination of equity and bond. You can do it in mutual fund also, so where you will have a better such combinations, and based on your risk appetite you'll get different percentage wise combinations you can select. Also you can go with large cap, mid cap, or small cap alone, or a combination of mid cap and small cap. So, and you can go for bond and equity combinations depending on your risk appetite. So that's why diversified portfolio is very important, and we are here going to discuss about other areas also like real estate, gold, etc. So when you grow over a period of time, you should start thinking about in these dimensions, because at this point of time, real estate, for some of you it may be affordable, for some of you it may not be affordable. So it need to be there in your bucket list, and over a period of time, you will be doing that, right? So for instance, if you look at during COVID pandemic, so what happened with the stock market? It was initially crashing, but what happened with the gold? Gold prices actually was going up. So those who had a mix of stocks and gold in their portfolio, they saw lower fluctuation. Or if you see overall the loss during that crash, it was very less compared to the others who are only invested in equities. Okay, so at that point of time, gold was going up, right? So that's the reason why you need to go for diversified portfolio. So let's look at this also, why diversification is important, something which we have already covered. See guys, especially when it comes to the Indian context, or not only for Indian context, in any context, why diversification is important. The answer lies in the reduction or reducing risk and management of market volatility. So India is also, like any other country, experiences its share market ups and downs due to factors like election or global events, economic policies, and natural disasters. So there are many factors which are affecting the stock market and stocks, right? So when you're diversifying your investment, that actually help you ride through these fluctuations with minimal impact. So when you have some real estate investments, these are limited assets. It's not going to affect you very badly like the way in short term something which can happen to stocks, right? So that's the reason why we need to have some diversification. And if you want to take an example, if you are heavily invested in banking stocks during 2008 financial crisis, you would have seen a massive decline in your portfolio values, right? So depending on that, if you are focusing or concentrating only on one thing and betting on one, it's like putting all your eggs in one single basket, and which is not a good idea for investment. But if you diversify, if you keep your eggs in different basket across, like in this case, not only bank, you are putting it in banking, FMCG, gold, your losses would have been significantly lower even during that 2008, that big crash. Okay, so remember this: diversification will not eliminate the risk. Risk is always there, especially when it comes to like 2008 financial crisis or 2019 or 20, that COVID, right? So during these times when the crash is there, the crisis will be there, but loss can be limited. These are situations which are unpredictable, right? So in this kind of situation, diversification actually help, but it won't eliminate the risk. Risk is always there, but it helps to spread it across different investments, and thereby the overall impact of that risk will be less. Okay, so let's move on to the next topic, where how you can diversify. See, if you want to diversify only with stock and bonds, simple and the best way is mutual fund, which we have already discussed, and in depth I will be discussing in the coming session. Otherwise, you can also think about gold. You also think about silver, which is actually getting a lot of attention from investors, and huge demand is also coming in silver, and have a huge potential for the future, because silver is used everywhere, right from building electric cars, or even semiconductors. Everywhere silver is actually used, so silver have huge demand, especially in the future also. So silver is again a very good investment, and then real estate you can look for if you have a fund. Okay, so let's look at asset allocation. That is actually the backbone of diversification. So let's get into the backbone of diversification. So which is asset allocation. Now, asset allocation involve, or what does it mean? Dividing your investment among different asset classes based on your risk tolerance, your financial goals, and investment horizon. So in which all areas you want to go, what kind of risk appetite you have, and what are your financial goal. Based on this, you are going to diversify. So you need to have some good knowledge about it. And over a period of time, we are going to travel together, and we will try to acquire that knowledge. And I'll try to share whatever knowledge I have during, with this experience that I have. So let's get into the details. Equity for growth. Discussed it many times, and you all know about equity. There is nothing much to talk about. Just for a formality, I'm discussing this. So stocks or equity, if you see, mutual funds, essential for generating high returns. So historically, if you look at Indian equities, have delivered 12 to 15% annual returns over long term. If you're taking over a long term, 12 to 15%, which is actually a decent return compared to when you have a significant investment which you have made, right? So 12%, 15%, these are very good, especially in the context of you are getting 7% as FD. So long term, if you can get this kind of surety, this is better. But again, the issue is that equities are volatile. So if you have some short term goals, this won't work. Okay, so equities better for long term, and because of its volatility nature, and so your allocation should depend on your risk appetite. Again, debt for stability. See, debt instruments like fixed deposits, okay, and government bonds and debt mutual funds, these are going to provide you stability to your portfolio. So these will ensure that return without much risk. Okay, so they offer lower returns, and it will be 6 to 8%, but they come with much lower risk compared to equities. Fixed deposit, zero risk actually, right? So again, bonds, technically zero risk actually. Okay, so the thing is that here the return is less, but risk is very less. Their return is also high, risk is high, and in fact, liquidity factor is also there. When it comes to fixed deposit, the liquidity factor is again a big problem. So when it comes to stocks, liquidity factor is very good. Again, the problem with real estate is less risky compared to anything. But again, the problem is with liquidity. You bought a land, and if you want to sell it for emergency, there may not be a buyer. In that case, you may go for a distress selling also. Okay, so that's again the problem with the real estate. But again, for long-term investment purpose, which is good. Short-term goals, don't go for real estate. So gold for safety. Gold has been, traditionally a hedge against all kind of inflation and market volatility in India. Now, during uncertain times, gold prices tend to rise. Actually, that's what I have discussed just before. During COVID time, when everything was crashing, gold was going up, and that will actually balance the losses in other assets. So technically and traditionally, there is a good potential is there when it comes to investment in gold, and you can invest in gold ETFs, sovereign gold bonds, or even physical gold also. There are a lot of disadvantages when it comes to physical gold, which we have discussed in the previous session, like safety, storage, making charges, and the other things, right? So various other charges also uh, that you can avoid with the sovereign gold bonds or ETFs, etc. Now, coming to the other tangible assets like real estate. So you can, when I'm talking about tangible asset, mostly I'm talking about real estate. Okay, so something physical, something which you can feel that you own it. That's something which is very important. So real estate investment provide steady rental income. If it give you rental income like 4 to 5%, that is going to be amazing, because the land value anyway is going to rise, and you're getting 4 to 5% anyway, which is better, much better than the fixed deposit. Okay, so real estate investment basically provides that steady rental income. And also the highlight here is the capital appreciation. But the issue is that real estate is an illiquid asset, which means if you want to sell it tomorrow, you may not find a buyer, and technically you may get trapped at that point of time, or you need to go for a distress sale. So invest only if you have long-term goals in real estate. Okay, now coming to some alternative investment. If you have higher risk appetite, you can explore alternative investments like real estate investment trust and other things, right? Or even cryptocurrencies. For example, like 1% of your portfolio. I am also significantly investing in crypto. Significantly doesn't mean that all the investment, maybe 15% I'm investing in crypto. But remember to keep a minimum limit, or keep it minimum, due to the volatility. If it works very well, but otherwise, it can uh, go bad also. So that's about the asset allocation part. Now coming to the step-by-step guide, okay, to build a diversified portfolio. So let's discuss this also in detail. See, first thing first, again, that you need to assess your risk tolerance. That's more important when you plan your portfolio. Your risk tolerance is your ability to handle the fluctuations in the value of your investments. Okay, so you need to have a clear idea about that, and based on that only you're going to invest. And if you have, or if you are a young professional, like in your 20s with a steady income, and then what you can do is you can afford to take more risk and allocate a higher percentage to equities. So if it work well, you get an early retirement also. Okay, so but if you are nearing retirement, you might want to shift more towards stable investments like bonds and fixed deposit. You cannot afford to take more risk. You cannot afford to see more volatility also, or sudden fluctuations in the portfolio also. So depending upon your age, your risk tolerance vary, and depending upon the fund you have or the investment you have, again, risk tolerance vary. Okay, so now coming to your financial goal, second element is you need to define. When I say define, means you need to have a very clear idea about your financial goals. So write down your short-term goals, your medium-term goals, and your long-term goals. For example, short-term goal could be, saving for a vacation. Medium-term goal, it can be, buying a car. Okay. And a long-term goal could be building a retirement corpus, or, buying a home. Okay, so you need to have a very clear idea, and based on that, we will have to allocate the investment and decide your asset allocation. We already discussed about the asset allocation. So based on your risk tolerance and your goals, which you have defined, you need to decide how much to allocate to each of these assets. For example, an asset allocation, if you are mostly I'm talking about 30 because we are all coming in that category, but there are many who might be watching this video in future, who might not be 30, who might be lesser, or who might be elder also. So at this point of time, I'm considering 30 because most of you guys who are watching me are in this age. So a 30-year-old investor could be 60% in equities, 25% in debt instruments. So that itself is around 85%, 10% in gold, 5% in alternative investments. Why? Because you might not have too much in real estate, but these things you can do. Equities you can do with whatever you have. Debt instruments you can try, right? And gold you can try. And other investment means there are limits. There may be limits for you when it comes to real estates at this age, but if you have, it is well and good. But since you have long-term goal, then you can do something here, and you can try 1%, 2%, or even depending on your risk appetite, some crypto also. So other alternative investment means that. So now coming to selecting your investment options. Okay, so guys, once you have your asset allocation, now choose specific investments that you want to make. For example, for equities, you can invest some certain part of it in large cap stocks like HDFC Bank. Anyway, it is going to perform good. Reliance Industries. If Reliance need to fall, India need to fall, right? So that is how it is. And similarly, if HDFC is gone, Indian banking system is gone. Do you think that will ever happen? If at any point of time HDFC collapse, what will happen to the entire Indian banking industry? Same with the case of Reliance. So what do we do? If Mukesh Ambani making money, we can also make money with that. If HDFC is making money, we can also make money with that. So what do you mean by investing in equities is, to the extent of the shareholding you have the ownership of that company. Okay, so that's how it is. And you can also go for, yesterday we discussed Axis Blue Chip Fund, mutual fund you can go with. So these are things which you can do for equities. And if you don't want to find it yourself, these are large cap companies where you can directly invest, or you can go with mutual fund. Okay, and I have already discussed about the returns it has provided for the last 5 years. It's around 12 to 15%. And for debt instrument, you can consider PPF, fixed deposits, or debt mutual funds, like, which again I have discussed already, ICICI Prudential Corporate Bond Fund. Or for alternative investment, you can go with gold, sovereign gold bonds, or gold ETFs, or later you can go with crypto, you can go with real estate, etc. So diversify within asset classes. That's the next thing again. Okay, so you already decided that these are things which you're going to do. Within that, for example, within equity, now you can go with large cap, mid cap, and small cap, like that. Again, based on your risk appetite. Okay, so diversification is not just about having multiple asset classes, but also spreading your investment within each of these classes. For example, even if you take steel, you can go for Tata Steel or Hindalco, like that you can divide, right? Similarly, banking, HDFC, ICICI, Axis, you can divide further within that. So that's what, within equities, diversify across large cap, mid cap, because mid cap have more growth potential, right? And small cap stock or funds. That's something which again you can do. And within debt also, consider mix of government bonds, corporate bonds, and fixed deposits. So these are different instruments where you can diversify by choosing an asset class. Within that also you can do the same. Okay. Now, always monitor and rebalance your portfolio. That's why you need to have a consultant, if possible, when you grow your investment, not necessarily at the early stage. Okay, a mentor is required. So over time, some investment may grow faster than others. Then you need to again keep changing your allocation, right? So for instance, if the stock market does exceptionally well, your equity allocation may increase from 60 to 70% at that point of time. So once you realize that here you're getting more growth, slightly you can make a shift. So initially, if it was 60, now you can change it to 70. So in such cases, sell some of the equity investments and reinvest in debt to maintain your original allocation also. Okay. Okay. Now coming to the examples. Okay, here you can see the example. So now let's talk about some real world example to understand how diversified portfolio work. What I can do is I can name a person who's very close friend of mine, Sanjay. Is 35-year-old. He's a software engineer from Bangalore. So he earns 1.2 lakh per month. Okay. And wants to build a diversified portfolio to achieve his goals of, buying house, funding his daughter's education and retiring comfortably. So at this moment, he is earning around 1.2 lakhs and software in staying in Bangalore. So this is his goal, buying a house and funding his daughter's education like that. So Sanjay's portfolio allocation should be 50% he can go with equities. Okay, out of which further diversify 25 in large cap stocks, let's say HDFC or TCS or any of those, okay, like that, large cap, you take it in that way, because we are not going to talk very specific large cap. And you can go with within that also maybe 10,000 in mid cap mutual funds and 5,000 something in small cap mutual funds, like that you can do. And next 30% you can do in debt, right? So here you can do let's say 10,000 in PPF and 5,000 in corporate bond fund, like that you can. Now coming to gold, a 10% of investment like 5,000 you can do in sovereign gold bonds, right? And real estate, 10,000 per month you can set aside from as savings for a future down payment. You keep it as savings, because in future if you get some opportunity to buy a house for making down payment and all, you can keep this. So that's how you can allocate as Sanjay. I've taken that example. Now every quarter he reviews his portfolio, and if his equity allocation rises above 55%, what he'll do, he sell some of his stocks and reinvest his that to his PPF to bring his allocation back to 50%. Okay, because if something is growing aggressively, then what will happen? This will close 50%, but your risk tolerance is 50%. Then take that rest of the amount, invest in debt instruments. So that is actually locked and saved. Okay, so again, you need to review. If it comes down, you can manage again. Okay, so this disciplined approach actually helps Sanjay to keep on track of his financial goals. Now coming to the next and a very important topic, actually, that is a common mistakes that you need to avoid. We talk about diversification, but the main issue is over diversification. See, diversification is essential, but investing in too many funds or stocks can dilute your returns and make it hard to manage your portfolio. So focus on quality rather than quantity. Too much of diversification, buying all the stocks which is not required. Second is ignoring risk assessment. Don't blindly copy someone else's portfolio. What works for you, you know, may be better, maybe different than what worked for your friend. Or what worked for your friend or some other person may not work for you in the same way, because your risk appetite will be different. Your financial goal will be different. Okay, so assess your own risk tolerance before allocating your investments. Now, coming to this one, lack of regular review. That's something which is again very important. Market change and your portfolio also. Market keep moving. It's not straight line. It is going up like this only. It goes like this. So your portfolio will be like that. So set a reminder to review your portfolio every 6 months or 3 months based on your free time. Or there should be someone who's taking care of this, who's ensuring that it aligns with your goals. Right? Now, before we conclude, let me, tell you these. Again, this is something which I want to repeat all the time. Start small, but start now. See, if you're thinking about a right time to start, it will never come. Yesterday was the right time. Did you miss yesterday? Now don't think about anything. You are not going to do it tomorrow. Do it today. So if you missed yesterday, which was the best time, the second best opportunity that you have is today. At least 1,000 rupee, start an SIP or invest in some equity, right? Do that. Okay, so don't need a large amount for this. You can start with 1,000 rupee also. Start with what you have and gradually increase your investments. Stick to your plans. See, it's easy to get swayed by market news and trends. Stay disciplined and stick to your asset allocation plan. That's why I've given you the plan. If you follow this, then what's the problem? We have taken care of market ups and downs and everything, right? And always consult your financial advisor. Okay, so if you are new to investing or feel overwhelmed, consult a financial advisor who can help you tailor your portfolio based on your needs. Always try to get expert advice and support. Okay, so guys, in today's video, we were talking about how to build a diversified financial portfolio or investment portfolio, especially in the Indian context. And I hope you find this video helpful in creating a balanced portfolio that matches your risk appetite and goal. Remember, diversification is not a strategy, right? But it's a mindset to protect your portfolio and to grow your wealth. So that's something which I want to stress upon again. Go for a diversification, have an expert mentor with you or advisor with you to help you in your financial goals. So that's it, guys. Thank you so much for watching. See you in the next video.